The Fed pause, or as it's been widely labeled, the hawkish skip or hawkish pause. The central bank's rate projections suggest 2 further rate increases this year, as Chair Jay Powell highlighted persistent inflation and labor market strength.
The conditions that we need to see in place to get inflation down are coming into place, and that would be growth meaningfully below trend. It would be a labor market that's loosening. It would be goods pipelines getting healthier and healthier and that kind of thing. The things are in place that we need to see, but the process of that actually working on inflation is going to take some time. It will be appropriate to cut rates at such time as inflation is coming down really significantly. And again, we're talking about a couple years out. I think, as anyone can see, not a single person on the committee wrote down a rate cut this year, nor do I think it is at all likely to be appropriate.
The move, and more importantly, that discussion got a lot of reaction. Economist Ryan Sweet called it a bluff. The Wall Street Journal's Nick Timiraos asked, why not just rip off the Band-Aid and hike now? Yahoo Finance's Myles Udland joins us. And I guess further emphasizing the difficulty that the Fed has, we just got University of Michigan consumer confidence coming in at a 4-month high, 63.9, stronger than economists had estimated. Inflation expectations coming down, which I guess is a good thing. But like all of this strength in the economy, not helping the Fed, Jay Powell sort of saying, skip, I don't mean to skip, because skip implies they're definitely raising. The next time, I don't know, the market did not, or market participants didn't seem to think he did a great job.
Well, I think initially it was a little bit surprising that, and I guess I wrote this 2 days ago now, that there was a consensus among Fed officials that this was the right thing to do. But the more time that goes by, and I think the UMich numbers are interesting today, the inflation expectations coming down essentially speaks to why the Fed would feel it doesn't need to raise rates anymore, because the whole concern about consumer expectations for inflation going higher is that they spend more today, inflationary spiral upwards, which is what you are trying to avoid more than anything as a central banker. But the more I've thought about it and kind of gone through what the Fed now has in front of them, they really managed, I think, to open a wider range of possibilities for themselves than they would have otherwise had. So sure, they took a cut off the table, but you don't need to you don't need to forecast that you might cut rates, because you're only going to cut rates in response to an economy that is materially slowing down. It won't be a mystery. But I think in this, current state of play where you have the economy continuing to be more resilient than people think, the optionality to basically do 3 things at each of the next 4 meetings is great for the Fed, I think. If I were the Fed, I would think this is great. I can either hold, raise once, or raise twice over the next 6 months. And coming into Wednesday's meeting, the only option was to hold rates steady because they were already at what they had forecasted the 2023 terminal rate to be.
And so one of the interesting notes within this initial reading here, the preliminary results for June, was, as it stands, sentiment remains low by historical standards here as income expectations soften. A majority of consumers still expect difficult times in the economy over the next year. So if you're the Fed, what do you do with that data?
I think with that kind of information, you are, kind of compelled to do nothing. Yeah. And I think that is, where people said Powell, the reason it was called a bluff, let's say, the Fed's actions on Wednesday, is because the bluff is about the next 2 hikes. If you look at, information like what you just said, Brad, consumers feeling down about the economy, the layoffs have kind of stopped, but every corporate leader right now has covered to say, things aren't really that good. We might do this, might do that. As long as that is out there, kind of in the ether, the Fed has, I think, kind of the downside put, if you want to call it that way, where they don't really need to be more aggressive, and they can say, well, there are some signs that this may come to pass. And that's basically the crux of every economist's forecast for a recession, right? It's going to happen the second half of 2022, then first half of 2023, now second half of 2023. And as long as the Fed kind of still has that out there, I think they, would feel more than content to do nothing.
And Myles, by leaving all these possibilities open, markets trying to make some sense of it, sort of still optimistic and sort of shrugging off the Fed here. What do you think this means in terms of Fed credibility when you do have so many options open?
Well, I mean, I think that the Powell Fed has earned probably more credibility than maybe some Fed cranks would want them to have earned. But I think what I look at what they did in 2022 is they continued to emphasize that they had one blunt tool, which was raising rates, and they did that quite aggressively. And then they stopped doing that when they felt like they were close to being, quote unquote, the job is done. They've reached the destination or whatever. And so in terms of how much markets are listening to the Fed, I think we can kind of look at the market reaction, like the stock market itself. And I think they kind of believe the Fed when they say we are close to the end of this thing. Now, I mean, there's always a staring contest between AI stocks and Jay Powell, whatever it might be, right?
Going first.
But ultimately, I think it's markets saying that, okay, you guys are probably done. Powell's like, well, we may not be done. But I don't think it's necessarily, Rochelle, to your question, like a credibility question, so much as it is we are in a traditional situation where markets and the Fed are somewhat in tension with one another, which I think is ultimately what any Fed chair would want there to be. But we played that SOT. I was actually surprised that didn't get more run, where he said, we're talking about a few years out, because
that's not what the dots say.
Well, but I think what it made me think of, which you'll remember, Julie, was Janet Yellen's first press conference. I think it was in 13 or 14, when she said, we might raise rates in 6 months or something like this. And it was considered like one of the great gaffes kind of in Fed history, because you put a timeline on when you were going to raise rates. And
right.
She had to walk that back for like meetings and meetings after that. They went to 8 press conferences essentially as a result of that. But no one really cared that much about Powell having given the year's time frame. I think because his credibility is such that when they move, they will be comfortable moving aggressively and perhaps materially in how they change their forecast.
And I think people have gotten used to, Powell is a little more stream of consciousness. Like, yes, he's deliberate and he's careful, but he also is quite transparent about how they're thinking. One of the things that strikes me about this moment in time is how much argument there is right now about what the Fed is going to do next and how much more is necessary. You have people like Double Line's Jeff Gundlach tearing his hair out and saying, deflation is coming, or Elon Musk, deflation's coming, the Fed has to stop now. I mean, he's been saying that all year. And then you have other people who say, no, they need to keep raising to get inflation back down to their target. Brian Railing of Wells Fargo was just on saying that. And it feels like that there's more of that sort of divergence and dispersion of opinions on that than usual.
Yeah, I mean, I think what has been interesting about the last 6 months, and I think the next 6, maybe the next 12 has more of this in store, is that, long and variable lags. Well, here we are in the long and variable lag. I mean, the banking crisis, right, is essentially an unintended consequence of what the Fed is doing. And so the calls get louder because, you have whatever you want to do, frog in the boiling water kind of thing, right? Like the temperature's been turned up on everything. So let's say you run a company that was venture backed and you would like to make an exit at a certain level, right? Can't do that right now. So you are very angry about what the Fed's going to do. You run a fixed income portfolio, you would like rates to go down, because then whatever you've been forced to buy in the last few, years, well, you won't be sitting on those unrealized losses, this, that, and the other. But I think we're at this point in time when obviously people's views on the Fed are mostly about their priors. If you run a stock portfolio, you want, you have a certain view, bond portfolio, another view. If you're a strategist, another. If you run Tesla, a third. But ultimately, when you get to this moment, those priors could not possibly be stronger in coming into your view about the Fed. And so I think that is, to your point, Julie, why the rhetoric feels a little bit hotter.
Yeah, everybody talking their book. And
yeah.
Yes, exactly. All right. Thanks, Myles. Appreciate it.